Well, thank you. Thank you, everyone. It is so good to see so many familiar faces. Thank you so much for coming today. For today, the format is going to be, I'm going to do about 5 to 6 minutes on GVF and just the 10-year celebrations that we're coming into. Then I'm going to ask Miles to talk about the US election, actually, and the various scenarios that might play out and how that might impact financial markets. And then we've got Mark Ambrose here from London. Mark and Miles run the portfolio together, and then we have 2 other portfolio managers in London as well. And we wanted to bring him round so that you guys could get to meet him. Okay, so let's get cracking. These here are the 2 CIOs. I am the CEO of a company in London called Stouty Capital. Stouty Capital is seconded into the ASX-listed Global Value Fund. And the Global Value Fund celebrated its 10th birthday in July this year, which is very exciting. We continue to have a very strong board. We've got Chris Cuff, Jonathan Trollope, Jeff Wilson, and Miles Stouty. And as you guys will know, we run a unique strategy. You know, we're not your traditional stock pickers. Instead, we go around the world looking for a very specific type of investment. In Australia, those very specific types of investments are called listed investment companies, but in other parts of the world, they're called various different names, but they tend to share the following characteristics. They tend to be closed pools of capital, they tend to be listed, and they tend to be vehicles that can purchase any type of asset. So you can hold global shares, you can hold global bonds, real estate, private equity. Mark's got a case study on real estate, US real estate, and he's also got a case study on music royalties. It's an update on last year's story. Now, if you or I want to purchase the value of those companies, we go and buy a share on the stock exchange, and we would expect that the share is worth the value of the assets. But it's in cases where the shares trade at a big discount to the value of the assets that we will get interested. We will start to do our due diligence. Now, it should be said that we kiss a lot of frogs, we turn over a lot of stones, but when we do find an investment that we believe in, we like to say, and it works, we like to say to our investors that they get 2 sources of returns. First, the returns from the underlying assets that we've purchased at a discount, and then secondly, the returns that we get from unlocking the discount or getting the discount out. And using this unique strategy, GVF has done a great job over the 10 years. We've annualized at more than 11% per annum with considerably lower risk. And I'm just going to spend a moment talking about that risk element. I know a lot of people will talk about protecting your capital, but I think I'll just show you, and I have shown this graph before, but I think it's a really good illustration of how we protect the capital. This shows every single trade that we've ever done in the 10 years that we've been going, and it shows the associated dollar profits on the left-hand side and losses on the right-hand side. Hopefully, when you look at this graph, you can see 2 skews. The first is that there's more wins than losses. And the second is that the quantum of the wins is greater than the quantum of the losses, which are 2 statements I really would like to hear when it comes to my own investments. Now, before we tuck into some cake, and there will be a cake delivered today, I want to make sure that we don't feel guilty eating this cake and that it's justified. So I wanted to dig a little deeper into how did the 10 years go. So I dug up the IPO prospectus and I looked at what was the IPO promise in the IPO prospectus. Well, the promise was GVF will deliver global share market-like returns, but it will do so with much lower risk. And I can tell you there was a lot of eye rolling because, of course, how many times have we been told, oh, we'll give you the S&P 500, but it'll be much lower risk. In that time, global share markets have absolutely killed it. In Australian dollar terms, from 1st of July when we IPO'd through to August 2024, so just over 10 years, global share markets in Australian dollars annualized at 12.3%, which was massive and magnificent. You guys will know it was the FANG stocks, the Magnificent Seven, have really driven the US economy higher, which has then in turn driven global markets. The 25 years before we listed, so from 1987 through to June 2014, global shares averaged 6.3% per annum. So it gives you a sense of how extraordinary these last decade has been. Australian share market has kind of behaved a bit more as we would expect. So annualized at 7.8% per annum. And over that time, GVF's average exposure to global shares has been less than 35%. So as you guys know, we go around the world finding these assets. We tend to hold a big chunk of global shares, a big chunk of global bonds, and then we'll have a smattering of other types of asset classes. We've run with less than 35% exposure to global shares, and yet we've still delivered that 11% per annum. On a risk-adjusted basis, GVF has outperformed global shares, has outperformed Australian shares, and has even outperformed the S&P 500. I can run you through the risk metrics that I've looked at in order to make that statement if you're interested. It's in the appendix. But I think being able to say something like that is pretty extraordinary and hopefully warrants the cake that we'll share together. A final data point for you: of 544 products in Australia that we looked at, 9 can say that they haven't had a down year in the last decade. GVF is one of those 9 products. The underlying assets performing well is great. The portfolio performing well is wonderful. But what has the shareholder experience been? That's important. Well, if you'd invested $10,000 with GVF at the IPO and you'd reinvested everything, your $10,000 would be worth $26,000 today. If you did half and half, we have some investors who take half of the returns and they reinvest the other half. Your $10,000 would be worth $20,000 and you would have received $4,000 in cash. Or if you're in the later stages and you're using this as an income product, because it very much has been designed that way, the default position is that we pay out all the returns to our investors. You would have invested your $10,000, you've received $8,000 in returns, and your $10,000 is worth over $12,000 today. Almost $13,000 actually. So hopefully that does a 6-minute job of reminding you guys of who we are, what we've done, and why we should share some cake after the presentation.